Hey everyone, it's Shelly here. September is here, and if you're like most investors, you're probably feeling the pressure of those skyrocketing tech stock valuations, right? But here's the kicker. Just because the numbers are up doesn't mean your portfolio is safe. Picture this. The major indexes are hitting record highs, yet many of us are scratching our heads, wondering why our accounts aren't reflecting that surge. I've got news for you. Those highs are propped up by a handful of tech giants, leaving the rest of the market in the dust. So, is it time to panic? Not quite. Instead, let's talk about why many tech stocks are overvalued and how you can pivot your strategy toward the undervalued gems waiting to be discovered. Ready to uncover some opportunities? Let's go. First, let's talk about the current landscape. Recently, major tech companies have seen their stock prices skyrocket. This has left many investors feeling optimistic. But we need to take a closer look. The price to earnings ratios for many of these tech giants are at historic highs. For instance, companies like Nvidia and Microsoft are trading at multiples that far exceed their historical averages. While this might seem exciting, it raises a critical question. Are these companies truly worth their inflated valuations? As for this question, maybe we can trace back to some history. Historically, we've seen similar situations before. Remember the dot-com bubble? Many companies with little to no profits were valued at astronomical levels, only to crash spectacularly when reality set in. While today's giants are more established, the lesson remains, high valuations can be risky. Now let's dig into the risks associated with overvaluation. When stocks are priced too high, it creates a precarious situation. If even a small piece of bad news or a dip in growth occurs, these stocks can take a significant hit. Just a few months ago, we saw how quickly market sentiment can shift when concerns over interest rates and inflation arose. Many high-flying tech stocks experienced sharp declines. This volatility is a reminder that when you're investing in overvalued stocks, you're essentially working a tightrope. So, where should your investment focus be? Let's talk about the undervalued stocks. These are companies that are trading below their intrinsic value, often overlooked by investors who are chasing the latest tech trend. Investing in undervalued stocks can provide a more stable and potentially lucrative opportunity. These companies often have a strong fundamentals, solid cash flow, and are positioned for growth. By shifting your attention to these stocks, you can mitigate some of the risks associated with the tech sector's volatility. In Shelly's investing journey, I've found that some of my best returns have come from identifying undervalued companies before they gain mainstream attention. It's all about patience and doing your homework. So now that we understand the risks and opportunities, how do we transition our portfolios? Here are a few strategies to consider. Number 1. Gradual reallocation. Start by gradually reducing your positions in overvalued tech stocks. This minimizes risk while allowing you to take advantage of potential gains in undervalued stocks. Number 2. Research and analysis. Focus on companies with strong fundamentals that have been ignored by the market. Look for low price to earnings ratios, solid balance sheets, and consistent cash flow. Number 3. Diversification. Don't put all your eggs in one basket. By diversifying your portfolio with a mix of undervalued stocks across different sectors, you can reduce risk and increase your chances to capturing growth. The S&P 500 price-to-sell ratio has surged to 3.23x, setting an all-time record. Well, above the peak of the dot-com bubble in 2000, yes, US equities are more expensive today than ever before, but that doesn't mean a crash is imminent. On the contrary, given Trump's policy agenda and the realities of the US economy, the market's lofty levels are likely to persist. Why won't it crash? because Washington will not allow it. Trump needs a booming capital market to validate his economic policies, and 70% of US household wealth is directly tied to equities. A sharp market decline would devastate consumption and employment, outcomes no administration could afford. In other words, US equities are like an overheated plane flying too high. The fuselage may be burning too hot, but the pilot in the cockpit will not let it fall out of the sky. Let's compare today's situation with the dot-com bubble. Number 1, tech giants actually make money now. Microsoft, Apple, Google, Amazon, and Nvidia each generate tens of billions of annual profits. With strong cash flow and healthy balance sheets, they are nothing like the hollow shells of 2000. Number 2, the government cannot allow a crash. For Trump, the stock market is the backbone of economic confidence, with 70% of household wealth tied to equities. A collapse would crush consumption and jobs, and unbearable costs for an administration. In fact, US equities have a national safety net. Number 3, extreme valuations are concentrated in a few names. The top 10 companies now account for nearly 40% of the S&P 500's market cap, with 9 of them above $1 trillion. This looks distorted, but unlike 2000's bubble of thousands, it is not a market-wide system bubble. The specific risks, that is, concentration risk. As of July, the top 10 S&P 500 companies made up 40% of total index value, a record. Apple, Microsoft, Google, Amazon, Nvidia, Tesla, and Meta have practically become synonymous with the US stock market. The boom is not broad-based. It's a giant's party. Most companies are still near long-term valuation averages, but because of the index is market cap weighted, as long as giants climb, the whole index is dragged to extremes. This setup creates two major risks. First, let's talk about overvaluation. Capital is too concentrated in a few stocks, pushing their PS and PE ratios for far beyond normal levels. Take Nvidia, for example. Its stock has nearly tripled in 2024, with market cap topping $4 trillion. While earnings are strong at 50 to 60 times forward PE, even a small disappointment could spark a sharp sell-off. Crowded trades. Fund managers must own the giants to avoid underperforming, so retail investors piling out of FOMO. The result, a one-way bet. Retail investors piling out of FOMO. The result, a one-way bet. But when everyone is on the same side, where do new buyers come from if prices drop? In April, a brief tariff shock caused the Magnificent Seven to fall harder than S&P, while the equal weight index held up better. This shows that high concentration can make downturns faster and sharper than expected. Most companies are not priced like Nvidia or Microsoft. Many sectors remain below historical averages. Hidden value traps turn value opportunities, right? For investors, this opens a high-low rotation window. Crashing the leaders risks buying at the top, while shifting into undervalued areas offers a chance to buy cheap and benefit from catch-up rallies. So, what kind of stocks that we should buy at this moment? The real value may lie in number 1, hidden AI beneficiaries. Traditional software, hardware, or even industrial firms trading at a modest PEs. AI adoption may quietly boost efficiency and margins, leading to the re-rating. Number 2 is mispriced cash flow machines. Companies in capital-intensive or high-debt industries hit hard by higher rates. Yet many still generate enough cash to cover debt and dividends. Once a rate cycle turns, they will rebound first. Number 3, certainty over imagination. Giants trade on stories. Smaller firms trade on contracts, orders, and recurring revenues. In times of valuation extremes, certainty itself becomes a premium. So, in conclusion, for investors, this is a long-term strategic choice. Stay center stage with the crowd and cheer for big tech, but prepare for painful drawdowns. Or move early to the sidelines. Spread bets into undervalued plays and wait for capital rotation. In markets, it's not the brightest stars that dictate destiny, but the balance of entire structure. When all the lights shine on one corner, the shadows may conceal in the next winners. So the key is high-low rotation. Shift attention away from the most expensive names toward undervalued, overlooked, and fundamentally solid companies. If you found this video helpful, please give it a thumbs up and share your thoughts in the comments about what undervalued stocks are you keeping an eye on, and don't forget to subscribe for more investment insights. Thank you for watching, and I'll see you in next one. Bye!